On today's hot sheet, I'm discussing Friday's job report, housing inventory for the last 7 days, and the FOMC preview, which is happening this week. Today is Monday, May 5th, 2025. I am Byron Lazine, and the hot sheet starts now. Live from Naples, Florida. Let me know in the live chat which market you are in today, wherever you may be. Let me know in the live chat. Let's connect together there. Best way to support the hot sheet and all of the content we put out here on the BAM YouTube channel is simply hit the subscribe down below. It's free. It's simple. Hit subscribe, hit the notification bell so that you're notified when these videos go live every Monday through Thursday when the markets are open. 9:30 a.m. Eastern, 6:30 on the West Coast. We go live with the hot sheet. It's the only 24-hour look back on the housing industry for the real estate professional. Send the hot sheet to somebody who can benefit from that. All right. The market was looking to maybe benefit from a jobs report. Obviously, the investors in the stock market look at these job reports one way. Jerome Powell looks at it one way. We look at it one way here from the housing perspective. You're not going to see rates go down until the job market really softens up. And while we saw maybe some signs earlier in the week on week over week data on jobs, right? We saw unemployment tick up week over week. The Friday report was the big report. That jobs report that came out on Friday, that showed the month of April, okay? And so we're looking at April in its entirety, and the job market certainly isn't weak. There's a few little slivers of information that could suggest that, hey, maybe there's, some future cracks in labor, but April's numbers were very robust. In fact, Bureau of Labor Statistics reported that payroll employment increased 177,000 in April. This is well above expectations for the month of April. So jobs strong, unemployment unchanged at 4.2%. So the unemployment rate is still relatively very low. In historic terms, this unemployment rate, even considering obviously population, all these types of things, this is a low unemployment number. Most, administrations, 4.2, it's a dreamy number on unemployment. One of the things about this number, though, is it's going to keep Jerome Powell from doing what this current administration wants him to do. President Trump, once again, is calling on the Fed to lower rates after this solid April's job report, okay? Jerome Powell, maybe other ideas, okay? They're going to be meeting here in 2 days, the FOMC. Jerome Powell, obviously the chairman of the committee here. And as they meet, they're going to point towards a job market that is robust. When we listen to the presser, which will be Wednesday afternoon, and we break it down here on the hot sheet on Thursday morning, I'm expecting Jerome Powell to say jobs are strong. I'm curious what he's going to say about economic growth. GDP went negative Q1 on the first reading. There'll be a revision. We'll see where that stands, but I'm curious to see what the GDP questions are going to be for Powell. 2 quarters of GDP decline typically means recession. I'm hearing that they're going to try to change those rules again if it happens and point towards, hey, you can't have a recession when you got 4.2% unemployment. That's one way to look at it. And so the job market, job numbers are so strong that we just don't expect the FOMC, Jerome Powell, and the committee to make any decision on cutting the Fed funds rate. Neither does CME Group. CME Group says, and this is when you get close to the meeting, like we are 2 days away. Really, the meeting is going to happen tomorrow and Wednesday, and then they're going to have the decision Wednesday afternoon. So we're a couple days away from the decision. When you get this close, the CME Group has been dialed. They have been super accurate on this stuff. So 98.2% according to CME Group that the Fed funds target rate is going to stay between 4.25 and 4.50. And, when you get this close to the meeting, they have been accurate. So no cut expected, according to the CME Group. In one of the factors that, holds this number up there at all but 100% certainty that they won't do anything is this job number. Okay, is the fact that unemployment is at a really low level, that they're adding jobs. Okay, that week over week unemployment number is not a trend. It's 1 week. We've seen weekly pops that have been similar to that. And the other thing here, you've got U.S. wage growth that isn't, because we have 7 million job openings, not 11 million like we had coming out of COVID. Wage growth has declined. Okay, so wage growth isn't something that you can point to as saying, hey, that's going to increase inflation. Okay, so there's a number of factors here, and until the labor market breaks, it's going to be very difficult to imagine that the Fed is going to help the administration out and just start lowering interest rates. The administration obviously wants to get some wins in the economic buckets. Lowering rates, something that they've promised, would be one of those wins. We didn't see that to close out the week last week. We actually saw the 10-year on Friday tick up a little bit, and we saw that with the readings that we had for the 30-year fix coming in at 6.9, the highest reading of the week on the 30-year fix, Mortgage News Daily. And today here to just kind of start this new week, 10 years coming in at 4.33. If we look at the last 5 days, that's the high level for the week. So we're kind of starting this week where we ended it last week. High level on the 10-year over the last week, high level on the 30-year fixed over the last week. We're still sub 7. We're back up over 4.3 here on the 10-year. That's near high level for the last 30 days. We did touch 4.5 one day. But we're not in the low 4s, which we've actually seen at different points here in the last 30 and certainly the last 90 days. 4.3 is kind of, relatively speaking, where we've been here for majority of the last 60 days. And so we're used to this spot. It's sub 7 on the 30-year fix is what it relates to, but we'll see as we go through this week. It's going to be all eyes on Jerome Powell. We're going to get to a little bit more of that here in just a second. Before we do that, let's take a look at inventory. It's the factor that can, change the outcome for buyers, more than anything except interest rates. If inventory continues to accumulate at the level that it's been, that can continue to put downward pressure on home prices, and buyers are going to have more options, more ability to negotiate, more ability to find that one seller who really does want to sell. So over the last week, we saw inventory increase from 728,000 on active single family inventory to 744,000. So it's official. We are in the first week of May, and active single family inventory is now at a higher level than at any point in 2024. Okay, this is the first week we can say that. The highest level in 2024 was 739,400 plus, and that was in October of 2024. Last year, what did we see from May to October? We saw inventory increase essentially every week, outside of a couple of weeks where it went sideways, holiday weeks down, whatever. But generally speaking, from this point in the year to that peak in October last year, inventory was on the rise. We would expect the same thing between now and the fall time, whenever that may come before the holidays. Typically, it happens a little bit before October in a normal market pre-COVID. But we would expect now until the peak level of inventory, that inventory continues to increase. So how high can it go is going to be the interesting conversation here through the rest of the year as it relates to inventory. 744,000, now 5,000 more than the inventory peak for last year. If we just look at October in 2019, last lower market, we were in the 900,000s. Do we get to the 900s on active inventory? We're 33% more than last year at this point, when we were only at 559,000. and room to grow. This is going to be the healthiest inventory year, getting back to normal levels. Lack of inventory, outside of pockets in the Northeast and whatnot, should be pulled out of the vocabulary for real estate agents. If you're talking on the macro, if you're talking, U.S. inventory levels, we are getting to a place, and we're going to get there by the end of the summer, where we're much more near normal. There are already markets that are higher inventory than pre-pandemic. I get it. Connecticut, Massachusetts, Jersey, New York, these things aren't going to make sense for those states. But for the rest of the country, inventory levels are accumulating, and they're accumulating quite fast. Now, Northeast is usually behind national trends. So, don't get high on your own supply. It can change. I get it. Northeast not building, right? 7 states make up over 50% of the building permits. So it's hard to imagine, but it's happened in the past. I think it would take a labor break. I think it would take some economic, uncertainty, not out of the realm of possibilities. Every single news outlet wants to drive uncertainty down everybody's throat. You have consumer confidence that's sinking, not rising. So when you have consumer confidence that's going down, economic issues can tend to rise. And so, I'm not saying that, inventory is going to rise in those areas that you haven't seen it yet, but it's possible. Okay. And we've seen that in the past. New listings helped out this week, 78,000, over 70,000 for the same week last year. So new single family listings, one of the drivers there to that inventory growth. Homes that are on the market, this inventory that's being accumulated, your serious sellers are not finding as much demand as years past. 36.5% on percent of properties with recent price reductions. That's over the 33%, which is normal. That's what we saw last year, more normal, 1/3. We're above that number. And then you've got 29% in 2023. So price reductions are on the rise as, inventory moves up and demand relatively stays the same. Existing home sales, we are at some of the lowest levels ever recorded, especially when you consider population on existing home sales. These are recovery level existing home sales closings. And you're seeing more inventory go up. So as more inventory goes up, you're going to see more price reductions go up. It's one of those supply and demand things that makes a whole bunch of sense. Might not make sense to the sellers who were been thinking about selling for the last 2 years, now go out to the market and hey, where's all that leverage my neighbor got? Well, where's all those multiple offers that everybody's talking about? Well, you kind of missed peak leverage position. And it's really just due to the demand. Okay. Altos Research reporting now that 402,000 homes in contract. That's 5,000 better than last year. Still not, we're not setting any records here on demand. Pending home sales aren't jumping off the page. You get another 30, 60 days right now of kind of riding this level of total pending home sales before the drop off ensues, and will continue throughout the rest of the year and into the holidays. So how high can we get on this level? 402,000 right now is the peak on pending home sales, and we'll see where we can take that as a macro market, well off of levels that you would come to expect in a more fluid market, but slightly above last year's level. So future looking, you get rates down. There's some positivity there. Rates, of course, have been tricky, to say the least. They've been volatile. Mortgage purchase application index continues to move down week over week. That was the story in April after tariffs slightly pushed rates down. They came back up. Uncertainty is the name of the game right now. 7 positive readings on mortgage purchase applications, 6 negative, 3 flat, better than last year. Out of the last 3 years, better than most. Okay. Better than most instances. I think last year, a year ago, we were up over 7%. We're sub 7. So doing okay in relation to what we've dealt with over the last 3 years, but nowhere near where we get that, increase in demand that creates a more fluid market. You got to get down closer to 6%. We're much closer to 7% and have been. Spread's not helping. That's one of the things that it kind of closed back up on us here in recent weeks. And we're looking more like a 2024 spread between the 30-year and the 10-year. It's an abnormal spread. You get below 2. That's more normal. We started trending that direction maybe earlier in the year, and we've gone the opposite direction. So spread not helping us between the 10-year and the 30-year. One of the many variables that is keeping, obviously, the 30-year fixed higher than what where we'd like it. Like to get it closer to 6%. We're into May now. Indications are the high side of a lot of these mortgage or 30-year fixed mortgage rate analysis are going to come in as opposed to the low side. 6% feels like a stretch right now with the data that we have at this point here on May the 5th. Consumer price index does continue to move down. Shelter inflation is cooling down to a level of 4%. When we look at the real-time data, this is, all the time, and this is obvious to us, but the Fed hasn't looked at real-time data. They look at CPI, which has a lot of backwards-looking data. Speaking of the Fed, the analysts don't expect a change, and that's what we mentioned there with the CME Group at 98%. They'll keep that target rate between 4.25% and 4.5%. They're going to start meeting tomorrow. That meeting tomorrow is obviously going to continue into Wednesday, as it always does. And then Jerome Powell is going to do his press conference. That's what we're waiting for, is his speech on Wednesday afternoon. We'll pick it all apart as we do every single time he does a press conference. We'll pick it apart. We'll share with you the notes. We'll put it into BAMX, obviously, and we'll break it all down here. Bank of America says policy rates on hold and no change in Jerome Powell's tone from his recent speeches. Bank of America also believes he will probably reiterate that the Fed is assessing the total impact of all policy change by the Trump administration, not just trade policy in isolation. We think the bar for a June cut is high, but Powell is unlikely to rule it out at this stage. So Bank of America says Powell's going to keep his options open when it relates to the future. Projections will not be released. We had projections last meeting. Okay, remember when we looked at projections from the Fed in March, their projections that come out every 3 months. Okay, so next meeting, because they do meetings 45 days, they'll have projections next meeting. Essentially, every other meeting they do their forward-looking projections. But if you remember back, to the projections that we saw in March, everything went up in the Fed's eyes. 10-year projections over the next couple of years, the 30-year fixed projections. The Fed believes these numbers are going to be higher for longer. Okay. After having, end of the year projections that looked a little bit more positive, they rebalanced that. New administration, they got some more data on that. And they're saying, hey, rates are going to be higher for longer. Obviously, the administration wants the Fed to play ball and take part in bringing those rates down. They haven't shown any interest in doing that. The FOMC midpoint of the target level for the federal funds rate is now at 4% at the end of 2025. And so that's 1 to 2 cuts this year. So fewer cuts are expected, and we'll see if that position has changed at all. When we get that meeting or that press conference on Wednesday after the meeting. Remember, here are the GDP projections. Okay. So in March, the projection was that GDP would be up 1.5 to 1.5. We went to 1.9. We went negatives in Q1 in the first reading. So it's going to be really interesting to hear what Jerome Powell thinks about that. Unemployment projections come in at 4.3 to 4.4. This was back in March when we looked at this, and we're still at 4.2. So, I think the job market's in line with what the Fed expects. It'd be really curious to see if they expected negative on GDP. And inflation still above target level here to end out the year on their projections. All right, that's where the Fed sits. We'll see what happens over the next 2 days. We'll break it all down on Friday, or on Thursday rather, after the press conference. All of those notes, as always, will be right inside of BAMX. If you're a member, this is where you find it. You go to Classroom, go to the Hot Sheet tab, and here's today's hot sheet with all of my slides. As well, the consumer price index, the total pending home sales, the inventory, single family, all broken out for you to use in your email or show communications. We've got our show notes and everything dialed up there for you inside of BAMX, school.com/BAMX. Friday's new content drop is also in here as well. So your hyper local content ready for you inside of the new Friday drop, school.com/BAMX to get in there. Make sure you have the app downloaded if you're a BAMX member. All right, there's your hot sheet here for today to kick off this week on Monday. Big week. It's Fed week. Stay with us all week on the hot sheet right here on the BAM YouTube channel. And of course, until tomorrow, toodaloo.